Hi, for everyone who's just joining, we're giving people a minute to get logged on and then we'll get right started. I think we'll go ahead and get started now. Jose, are we ready?
Ready and good to go.
Okay, great. Hi, my name is Nirupama Raghavan. Welcome to Dharma into Action's second webinar in our Dharma Women in Finance series. Dharma into Action Foundation, or DIA, is an association of Dharmic American leaders and philanthropists interested in preserving and celebrating the philosophy, culture, and traditions of South Asia and East Asia. We also apply these philosophies to modern day issues, including bringing meditation and mindfulness to help first responders deal with the very real stress of their jobs, and helping students learn and apply Dharmic values at this key transition point in their lives. If you're interested in learning more about DIA or becoming a member, I'll put links in the chat area after I finish the introduction. We have a particular focus at DIA on women of Dharmic backgrounds, exploring our unique experiences and challenges. Dharma Women in Finance series studies the different finance needs that women have versus men. In our last webinar, we had several speakers, including Seema Ingarani, the founder of Girls Who Invest. We discussed the idea that between men and women, there exists a wage gap and an investment gap. And over a career of 40 years or so, women may accumulate a wealth gap of approximately $2 million versus their male peers. And this situation is further exacerbated by the fact that women tend to live longer. So our wealth needs to last for much longer. In this segment of Dharma Women in Finance, we'll focus on the fundamentals of investing and starting to develop the framework for managing your own portfolio. Understanding what's important to you and for you is the first step in your investment journey. Please note that this seminar is not intended to offer specific financial advice on specific stocks or other investments, but really to help you think about how to invest for yourself. Our speaker, Teja Rao, has a background in law and social work. She's worked with women going through life transitions, including high asset divorces and estate planning that required difficult financial considerations, education, budgeting, and planning. So I'm going to turn it over to her now to talk a little bit more about her interest in this area and walk you through some of the principles she's applied in her own life. Welcome, Teja.
Thank you so much. Thanks, Niru, and welcome everybody. I'm so glad to see so many people joining us this afternoon. I am speaking to you from beautiful Barcelona, Spain, where money is still money. Same as in the US, although just a different currency. So today, as Niru mentioned, we're going to be talking about women and the basics of investing. And this really is intended to kind of break down any initial barrier, self-confidence or intimidation factor that you may be feeling. And it's being presented to you as, I'm presenting it to you as sort of a personal journey that I took, and also give you some resources that you can use and information that you can use to start your financial journey as well. So I'm going to share my screen here with everybody.
Teja, if you would, let us know how you would like to take any questions or comments people have.
Sure thing. So if it's possible to put your questions into the chat, that would be helpful, because then other people may have a similar question and can see it coming up ahead of time. And we will take breaks during the course of this webinar to answer questions and have discussion and share also information that you may want to with other people. So if it's okay, if you could please do that, I would appreciate it if that works. Sorry, give me just a second here. There we go. Okay, so I hope everyone can see this. I fully admit I'm not a graphic designer, so here we are. just a little bit of a roadmap. I'm going on what we'll be covering today. A little bit about me. We're going to go over some very, very high level terms that you want to familiarize yourself with. And we will be making this presentation available to the people who have registered. It will be emailed out to you after the webinar. So if you want to take notes, please do that, but also you'll have it for your reference. We'll talk a little bit about your investment style and needs. And investment is there in brackets because it involves a lot of different things taking into consideration, not just where to put your money, creating your plan, and then steps to take after we finish this webinar today. It's certainly not a one and done thing. And then we will have opportunity for questions and discussion as well. Okay, so Nero gave you a little bit of background about me. I spent 16 years as an attorney and partly a couple of 4 years after that working as a social worker for the state of Maryland. Social worker being in the macro sense, I worked with families, with systems where families were going through transitions. And part of this involved understanding money, understanding where it was, what to do with it, how to deal with it. And despite having spent my career working with families and working with people and their finances, I found myself in a position of not having done the same for myself. So I very much had to start at the basics and build up my own knowledge because I wanted to know what to do. I think most of us kind of have a set it and forget it mentality when it comes to our investments. And that's a good mindset to have, but it only works if you have a fundamental understanding of what you're doing, what you want, and what your goals are. And so for me, this involved when I was about 43, a few years ago, kind of taking all of this into account and really seeing what is the path in front of me and how do I want to achieve it financially. I have a family, and some of you may have children. I have two, one in university, and I really wanted a life and a lifestyle where I could be comfortable and I could pursue the things that I wanted to pursue and spend time with my family, taking care of them as well. And so these were all of the kinds of things that were going through my head as I started down this path, the finance and learning about finance path myself several years ago. In addition to bringing everything that I'd learned, practicing and working with families for the 20 years before then. So today, just to be clear, these are the topics we are going to be covering. Terms that are helpful for you to know, demystifying investing a little bit, identifying what you think your needs are and what your goals are, and creating an action plan for yourself. If you have a piece of paper and pencil with you or a notepad or your notes app, feel free to do it that way. What we're not doing today is giving you any kind of advice specific to your situation. Everybody's situation is unique. And certainly I'm happy to share resources to get you to start identifying resources, professionals to engage with to do that. We were not going to be talking about what assets to buy or avoid. I'm not going to be telling you what stock to buy low and sell high. This is not that kind of discussion today. And we're not doing any kind of personalized financial planning today either. So before I jump into that next scary looking slide, I'm just going to pause here for a moment because I think we have a couple of questions in the chat, but I can't see them. So Nero, I'm wondering if you can. I think because I'm sharing my screen.
Actually, I don't think there are questions. It was just me putting the links in.
Okay, thank you. I'm not stuck. There we go. Okay, so this is the scary slide, but it's okay. It's going to come to you. And I know we have a lot of people on this call today, and for some of you, this may be extremely basic. For some of you, this may be brand new information, but it's always best to start with the fundamentals. So one of the things I found most frustrating when I took over my investments several years ago was the manager that we had been using for years, for 15 years. Wonderful company, wonderful guy, did great work for us. I had no issues. but I always felt like I was having conversations that were going above my head. And there was never a moment to stop and explain, or if it was explained, it was just, kind of like you're wasting my time. You're, in a rushed way. And so I did my own reading. Thank you, internet. And these are kind of the very, very basic things that you should start considering, which are, of course, stocks. 3 types. The big ones, the large cap, meaning these are the big companies, the Microsoft, IBM, Johnson Johnson, big companies that are out there. They're safe, they're reliable, they're well-established, and it's a good thing to have in your portfolio. Their returns tend not to be huge because they're big and safe and reliable, but they're established. You have mid-cap companies. These are, again, mid-range, intermediate-sized companies, and they're also safe, they're also reliable, they're smaller, but they may be just as established. They're just a smaller company. And then you have small cap stocks. And these are, I know 300 million to 2 billion sounds huge, but in the grand scheme of things, these are smaller companies. They tend to be a little bit more volatile. They're a little less reliable, maybe because they're not as established. But there's a full range of companies across these 3 tiers. And when you start looking at your portfolio, you want to make sure you have some of each of them in your portfolio, depending on what your risk tolerance is. And we'll talk about that in a little bit. The second thing, you may have heard bonds. Everybody loves bonds because, again, nice and safe. There are 2 types, though. They're government bonds and they're corporate bonds. And they offer a fixed interest rate. It's usually super low. But again, the idea with bonds, nice and stable. It's a good foundation for your portfolio. And if I'm going too fast, please put it in the chat. If I'm not going fast enough, I can speed it up. Mutual funds, and again, these are typically a group of stocks that are put together. They're organized somehow. And for those of you organized by area sometimes, so for example, if those of you who are interested in environmental causes, there are lots of mutual funds related to the environment. Those of you who want to support women-run businesses, I'm sure you can find a mutual fund related to that topic. So it's typically a group of stocks, and I am simplifying, I understand that here, but again, it's to make sure that we kind of start at a fundamental level. They may be managed or not managed, meaning there might be somebody behind the wheel. And typically, if there is, they'll have a fee associated with it. And the fees vary, but it's something that you should watch for, because again, of course, it would eat into your bottom line if that was the case.
AJ, we have a question. The question is, do bonds always have to do with investing in military funding?
No. There are government bonds, for example. There are bonds for your local county. Montgomery County issues municipal bonds. The state of Maryland issues bonds. So no, they do not have to have anything to do with the military. There are also corporate bonds out there, and I have a mix of both in my portfolio. There we go. We have mutual funds, which I just went through. The next up, exchange traded funds. This is kind of a new kid on the block, relatively speaking. These are like mutual funds. So with mutual funds, they trade once per day, typically at the end of the day. Exchange traded funds are kind of like a mutual fund in that it's a group of stocks all put together, but they trade all day long, like a regular stock. You can buy one now and sell one, an hour later or 5 minutes later. I don't advise that, and I'm not advising, but they function a lot more like stocks do, and they trade all day. And just like mutual funds, they can have fees also. There are also, you might hear of index funds, mutual funds and exchange traded funds or ETFs. They have index funds, and they mimic the market. So the stocks put into that fund, individual stocks put into an index fund, they try to mimic what's happening across the entire market. So, it's nice because you can see them rise and fall with the market as opposed to going off and doing their own thing. So they tend to be popular also. Commodities, I'm sure you're familiar with. We all love gold. So commodities are any kind of tangible, it's a thing. Gold, silver, crude oil, agriculture, these are all commodities. And so, for example, in my portfolio, I have gold as a commodity. I have a gold exchange traded fund, for example. Real estate, your homes, of course, that's real estate. But there are also real estate investment trusts, REITs, which are like a mutual fund for real estate. Okay, and then I've put these three on a separate page because they tend to be more volatile. They're high risk hedge funds, we all know, high management fees. They try to beat the market. They're managed by a private entity typically. And it's not something that I'm personally familiar with. Another new kid on the block, we have SPACs. You might have heard about these in the news recently. They're very popular with athletes, for example, super high risk. And they're essentially people trying to raise money to start a business. So you are buying shares in a company that technically doesn't exist yet, or there's nothing quite happening yet. So it is considered high risk. And then finally, everybody's favorite topic, crypto, or some people confuse it and say Bitcoin, but Bitcoin is a type of cryptocurrency. And it's popular because there's no bank involved. It's decentralized. It sounds kind of fun. I know that sounds silly to say, but it's nothing that's insured by the FDIC. Very, very high risk and high reward also, on the other hand. These are some names of the different types of crypto that are out there in the world. And to be honest, I own crypto in my portfolio as well, but I only own the amount that I'm willing to lose. So I only put in the amount of money that if it fell out of my wallet on the street, I would be sad about it, but I wouldn't cry over it. It looks like we have a question.
Yeah, we have a question. Are index funds traded all day or once a day?
Well, it depends. And if it's a mutual fund that's an index fund, then it would get traded once a day. But if it's an ETF, then it could be all day long. Okay, so how did I start on this? I started at the basics myself. I kind of opened up my statements and really took a good look at them, just as I used to do with my clients. I know this sounds very strange, but having to turn the mirror on myself was a very interesting exercise. So I started by looking at what I was already doing. I was already saving at work, which I suspect many of you have 401ks or IRAs or other things like that. I created a budget. Actually, I had a budget, but I made sure that I was following it, which I was for the most part. I identified things that I liked saving for, vacation. There was a business that I wanted to start saving up for, to potentially begin. I started learning about investing and really kind of throwing myself into the topic as best as I could. I started talking with people, not your partner, my partner, my business partner, I should say, with children, with friends, with everybody about investing, really just kind of having that conversation, which can be difficult. But I actually also found that to be a good place to begin, because it was one of those things where nobody was talking about it until I said something about it, and then everybody would talk about it. So people want to talk. And so if you find yourself hesitant, bring it up as a question. Say, what are you doing? How do you handle it? And I found that to be really helpful in a lot of ways, especially when it came to giving me the confidence to do more for myself. And
good question. There's a bit of a conventional wisdom that it's uncouth to talk about money in social settings. So how did you overcome that?
To a certain extent, I agree with that, Nero. Asking somebody what their salary is, obviously, I'm not going to do that. But I did ask, hey, what do you use somebody to manage your money, for example? Because I had been using somebody to manage my money. But I wasn't sure if that was necessary or if it was the kind of company I wanted to go with. So that felt like kind of a safe question that I also wanted some information about to ask. I also would ask, have you made any changes recently that you feel willing to talk about? And these are conversations I had with close friends. I'm not talking necessarily about party talk, but conversations with close friends. What company are you with? Do you pay fees? Are you happy with the fees that you're paying? Because that was another concern of mine. And so I wasn't necessarily asking people the specifics on, hey, can you tell me what hot new stock you picked that I can invest in? I was not asking those kinds of questions, but I think most people are willing, depending on how close they feel to you, how much they want to share. And I think the more we talk about it, the less taboo it becomes. So yes, so meeting with a financial planner. So as I mentioned, I did actually have a planner at that time, and somebody managing my investments for me. And I would meet with them twice a year. And we would also have a quarterly call and go through what was happening. And this was a service that was already being provided by Charles Schwab, who is who I bank with, but I'm not necessarily recommending them for you. That's just the institution I happen to use. And the more I did that, the more I thought, I would like to do this myself. But it was good to meet with them, to create a plan, to talk through what I wanted to do, and to kind of have that support from them. And so I would encourage you to look, whoever you're banking with, Vanguard, T. Rowe Price, Schwab, whoever it may be, to see if they offer it as well. Because there are resources out there. You don't have to do it yourself. So one of the things I did right off the bat was assess my comfort level with risk. I am risk averse when it comes to money. I'm not a big spender. I'm very conservative. And I wanted that to carry through to my investments, but that may not have been right for my goals either. So the first thing I did was identify how much do I need for my daily budget needs. These are literally your bread and butter kind of expenses. And then, do I have some short-term goals? How much time do I have when it comes to investing? So I'd like to think relatively young at 47. So I have some years ahead of me. So I could afford to be a little bit more risk tolerant. And so am I being too conservative for my age was something that I had to think about, really. And how much am I willing to invest? That was another question I had for myself. I didn't want to put everything into investments. And again, this all has to do with how comfortable I felt with putting money in a place where I couldn't immediately access it if I needed to, for example. I also looked at my financial situation. So not just the income, but also, what kind of mortgage, credit card, other kind of debts I had, really taking just a objective, hard look at this is what's in front of me. What kind of insurance I had in terms of health insurance, life insurance, and so forth. How much cash I had on hand, especially for an emergency fund. And what was my budget to meet just my regular recurring expenses. And this took some doing, to be frank. It's not something that happened in an afternoon, and it's not something that I did consistently either. It took, I would say, a good 3 months to kind of lay out a plan from start to finish after looking at everything I had. The next thing I did was something I've always done, but I'm laying it out here, was to plan out some of my life goals. So short term, I have 2 children, and one of them is done with in university and the other one's in high school. I knew I wanted to travel, and I knew I didn't want to kill myself working anymore. I also laid out some midterm and long term, and of course, there's that old saying, man makes plans, but God laughs. These are my plans, but let's see what happens. You never know, but it's always good to identify what goals are. And these were the goals I set for myself, short, midterm, and long term. And I realized one of the things I wanted was to be able to pursue passion projects and travel and really enjoy the time I had with my family. And that would mean trade-offs, right? So this is where the budgeting for daily expenses and the long-term with investments kind of came together, was to see how the two really had to work together. And so I'm going to pause here for just a second because, Nero, I'm wondering, these are my life goals, but I know my life is not of course, the same as everybody else's. And so I'm throwing the question back to you, Nero. What do you think? How, if you were to do this for you?
Yeah, certainly I could share mine a little bit. I don't think I've given it as much thought as Deja has. And, certainly that's something I plan to rectify right after this conversation. But I don't have kids and I'm not married. So my goals are very different from Deja's. And, so I don't have to worry about university and things like that. But I do want to have to take care of my healthcare and my ability to support myself for my hopefully long life. So my goals long-term are around ensuring that I have proper funding for healthcare and for my living expenses. At the same time, in the midterm to long term, I would say I have a very much a focus on how to do good in this world. So I want to make sure that where I am investing is building, is generating good for the rest of the world. So I want to make sure I'm investing in companies that are focused on addressing issues like climate change. They're focused on social justice and investing in, women minorities that have potentially been disadvantaged in the economy. So to me, those are the sort of things that I'm interested in thinking about when it comes to, the legacy I want to have, the needs I have as an individual. And I also, I enjoy the pleasures of life as well. So both short term and midterm, I'm looking at, how could I travel more? How do I make sure that I'm able to go see my family around the world? So again, very different types of goals from what Deja has, but I'm also thinking about the impact I want to have in my life as well as through my investing.
Nuri, you brought up a really great point in terms of the intersection between life goals and investment goals, where something that only just, and I think it's because of the stuff that's happening in Glasgow with the climate change summit right now, something that is fresh in my mind now in terms of these life goals is, what impact am I having? Can I have an impact with my investments? Should I take a look at them? I kicked out ExxonMobil and Chevron and Shell from my portfolio years and years ago, but what more can I do? How else can I make an impact? Certainly that is something that I'm starting to think about more and more, even just in life goals. So that's a great point. Lost my.
Well, while you're moving on, I'm just curious if there's anyone else in the audience who wants to share how they're thinking through their life goals and how that might impact investment. If anyone's feeling brave and would like to share, that would be wonderful. Okay, appears not.
Yep. Well, they're thinking about it. Yes, exactly. Food for thought as you start working through this. So the next thing I did, of course, no good deed goes unpunished. You have to have a to-do checklist. And again, super high level, and I might be simplifying this a bit, but I inventoried everything that I had, everything that I have. This is really kind of the nitty gritty, got all my latest financial statements together. That was frankly, a pain in the neck. Having to go in and download the latest statements, look at the year-end statements, open up, the paper statements that were coming in, and making a list of all of the things that I held in my retirement accounts and at the time in the mutual funds and that I had. Some of this was easy to do because I had a manager. I had a money manager at the time, and so a lot of this was getting information from them that they were easily able to share already because they had been doing it. But I also really took the time to go through it and understand what was there, so that I could find that risk tolerance. And it has shifted over time. Where I once was very risk averse, I've opened up a little bit and become, I would say, more moderately tolerant to risk at this point. And to see what percentage of my portfolio is high, moderate, or low risk. So when I first started out, the biggest part of my portfolio was the low risk stuff. And the smallest part was the high risk. And now when I take a look at it, which I just did, I try to do it every 6 months or so, every quarter, every 5 months. I find that actually the majority of my portfolio is moderate risk. Still high risk is still a very, very small percentage. Again, only that I'm willing to lose. But I've shifted a little bit as well. And I think that might have to do somewhat with my comfort level in dealing with these things. I also decided if I wanted a planner and a manager for myself. They're not for everybody, but they certainly are super useful and helpful. And I really liked having one. But I made a personal choice to not use one and to see if I could do it on my own. Does that mean it's going to be forever? I don't know. I might change my mind in the future. But for now, this is a decision I've made. And so far, I'm very happy with having control with my investments. And we'll see how it goes, I suppose. As I think I mentioned before, my financial institution happened to offer this service for a fee. They charged, for me, it was slightly less than 1% of my portfolio value. I think it was like 0.8% or something like that. But check with who you use and they may have the same service. Balance my portfolio, and then the rebalancing every 4 to 6 months, which is actually something I'm doing right now. It is a bit of a set it and forget it. There were times in the past 6 months where I would kind of look with one eye open like, oh my gosh, I don't want to see. But it really, if I'm in it for the long game. So, I try to take a measured approach and not freak out and sell or buy, to make myself feel good, to make, any anxiety I might feel, to quell that I'm really trying to make these decisions more objectively.
Teja, I think that's a really good point because, oftentimes people who are investing are portrayed in movies and TVs as checking their balances every day, day trading, et cetera. And it's a very frenetic experience. And that's really not what most of us do or really should aim to do. We also have a question from the audience here. The tweener generation, younger baby boomers, and I would say also Gen X, has obligations on both sides: children, education, first house, and aging parents, retirement, healthcare. How do you manage these potentially conflicting uses of capital at the same time?
Meaning that you have to pay for some things right now, but then also
well, it's like your parents, taking care of your parents, taking care of your own retirement, as well as taking care of kids who might still be dependents or in college age and things like that.
Sure. I think that's where you really have to kind of lean on your short, midterm, and long-term goals and balance. For example, balance your portfolio across what your needs are. So I'm not in this for the short term. So if I needed a lot of money right now, for example, to pay for my son's university, I don't know that I would be able to all of a sudden become a high-risk investor, because investing very much is a long-term strategy. So I think if you're trying to balance, and I'm coming up on that a little bit myself, with my family, it really has to do with what you feel comfortable putting your money into. So when it comes to college education, for example, we all know college can be borrowed against. You can't borrow for retirement. That's kind of a fact of life, which is why we don't stop putting money into our retirement accounts, because again, college can be barred against. It's not ideal, but these are trade-offs that need to be considered. So I'm not sure if I'm quite answering the question, but I'm happy to take another shot at it.
Yeah, let us know if you'd like to do a follow-up live, and we're happy to arrange for that too. But I would like to, one thing I'd like to say is it's never too late to be thinking about these things, because I think sometimes feel that if they didn't start in their 20s and 30s thinking about investments seriously, it's too late. And I would encourage people, regardless of where you are, take stock of the short, mid, and long-term goals that you have, and then think about how to invest accordingly.
Yeah, I totally agree. I don't think it's ever too late. Again, it's not something that you want to be in the habit of putting money in for a quick turnaround and a high payoff. That's high risk investing. It's not what I do. It's not what I'm, tolerant of risk wise. But there's always a time. I think there's always space to start. Whether it's for yourself or for your kids. But this is, again, it's not a place to really start if you need money right away. And that's kind of where you hear a lot of the stories, as you were saying, Nero, with the day trading, with people getting sucked into GameStop, for example. You heard lots about that with cryptocurrency. I think there's a lot of desperation sometimes in that I can turn this around quickly. And again, that's just not my style. That's way too high risk for me. So I took a more moderate approach. I think a little bit later in life. I started in my 20s with my retirement account at work. That's what I had for the most part, and that's slowly grown over time, but it's still never too late. Okay, so I'm not a graphic designer, but this is my fanciest slide, so I'm very proud of it. So I built my portfolio, and there are lots of graphics out there that show this as a triangle, as a pyramid, with high risk at the very top, like a food pyramid, high risk at the very top, and low risk is your base. And when I started off, low risk was my base, and high risk was at the very top. And over time, it has shifted a bit so that moderate risk is actually my base now. I tend to seek just a little bit more in return. We're not talking huge numbers here. I might have shifted, if it was a scale of 1 to 10, I might have gone from like a 7 to an 8. So that's what I mean, little bits. But the decision really has to come down to you. And again, what are your goals? What's your comfort level with risk? And what are you seeking out of this? So these are some questions I asked myself. And when it comes to moderate risk, the third bullet point there, how patient can I be, is really the question that weighed on me. How patient can I be with my return? How willing am I to leave it alone, to buy the things I want to buy and then leave it alone? And with low risk, is it worth it? Low risk, I have, hopefully, God willing, I have several more decades of life in front of me. So investing in government bonds and CDs and so forth, I can wait. I have that fortune, that I have some years in front of me. So if I buy a government bond now, it can mature nicely over the next couple of decades. So these are some of the questions that I asked, and I continue to ask myself. Again, this is not one and done. You have to kind of continuously do it. And this is what I just screenshotted this today, actually. This is what my portfolio looks like right now. And you can see it's about 53% in anything that says cap is stocks. So it's about 53% right now, I think, if I'm doing my math correctly, in stocks. And then the rest in bonds. I do have some gold and some cash. And so this is, this is my Excel spreadsheet pie chart that got generated. And it's something that after I looked at this, I realized I want to rebalance it a little bit. Again, a little shave here, a little, add there, not huge amounts, because again, I'm in a set it and forget it mentality where I'm monitoring. I'm rebalancing maybe every 4 or 6 months, but for the most part, I'm just letting it grow. And sometimes it doesn't grow, and that's okay. That's when you kind of have to look like this at the screen. So what I did was, and I'm also happy to share this with people, I have a spreadsheet that I use. If people can see this, Nero, I think people can see this, right? So this is a spreadsheet, just a Google sheet, and
We can see it, by the way.
okay, great. And if you do bank online, if you do have your investments online, you should be able to just pull a download of what you're holding. And these are the various asset classes that I hold all the way over to the left. And then these are the targets that I allocated for each one of those classes. And it's an art, it's not a science, it's what you're comfortable with. But I want to make sure that I have some targets in there. That's the target percent of the entire portfolio. So I wanted to say 15 to 16% of my portfolio is US large cap, meaning big companies, the Microsofts and the IBMs of the world. The big companies are the large cap ones. I wanted a fairly substantial amount of my portfolio to be that. But you can also see further down here, my treasury bonds are also, these are in my retirement funds. They're also a substantial portion of my portfolio. So it's kind of balanced out where I have some big, again, what are supposed to be the reliable, big kind of dinosaur companies that give a steady return, nothing too volatile. They're a part of my portfolio, but then I also have some bonds in here to keep everything nice and slow. That's the idea, nice and steady. And then this sheet is pulling from Google Finance, and I'm happy to share this with folks. These quantities, these numbers are all fake, by the way. The Google Finance prices are not, but these quantities, these are just, these are examples for you. And so you would fill this in with whatever you have. And these are just, I plugged these in literally 5 minutes before this call so that there would be numbers showing and not error messages for these cells. But this is one way to track, and it does take time. I fully, admit it takes time to do things like this. But the nice thing is these days you can also pull it from your, directly from your investment company. So if you want to do it, I would recommend you do, because it's a lot easier to review the information than waiting for the statement every month. So that is what I have. I know I threw a lot of information out there, or maybe not so much, depending on what your baseline is already. But I think we have plenty of time for question and answer. And something that I wanted to start with was looking at planned life goals. So I wanted to get people sort of envisioning their future, their current and their future, and start thinking about where they want to be and then how investing can help them get there. But then we may also have some specific questions. So this is our chance to do that.
Yeah, so why don't we do this? Jose, if you could promote people to panelists so that we could have more of a conversation and they don't have to necessarily go through the chat. Of course, it's entirely up to you if you want to be on video or not, or if you want to ask a question or not, but this way at least it can be more of a conversation. And while we're waiting for that to happen, Teja, I think you've given me a lot to think about. Like many people, my first forays into investment came because I had a job that offered a 401k.
Mm-hmm.
And so I had to do a little bit of thinking. They obviously had some recommendations for us, but I had to choose between different options. And then slowly I got a little more interested. And like you, I take a buy it and be done with it and let it just type of attitude for it. And I want to be much more active in it, particularly now that I want to focus on investments that match more closely to my personal beliefs and my goals and the legacy I want to leave. I'm curious as to, you've laid out a very detailed, methodical approach here, but I'm curious as to, was it always this detailed? Was it always this methodical, or did you start with a simpler?
Well, I started, like I said, despite working with people who were going through life transitions and needing to deal with their finances, it was the first time I really turned the mirror to myself. And I literally started with opening statements, paper statements, and laying it out in front of me, which is why it took 3 months. It was not this, it looks nice and clean now, but really, as I was putting this together, I realized how long and how much work it had taken to get here. So it is messy, but it's so worth doing. And it's one of those things, the more you do it, the more interesting it becomes. And that's what I really found helpful. Was I thought it would be something that, I have to do it, but it was actually really interesting to kind of see what was happening with my money.
Interesting. I think we seem to be having some difficulty promoting people to panelists. So if you do have questions, please do put them in the chat or raise your hand, and we'll try to make sure. Oh, I think we say here, can you elaborate on the difference between men and women in investments?
Sure. So, this is, I think in one of our prior webinars, we had actual, the actual background references for the statistics. But generally speaking, what we learned through the course of this project, and part of the reason we started this project is because men and women are different in their investing. Men tend to be more risk tolerant and jump in. And they also tend to invest with different goals in mind. Where my life goals and women's life goals tend to focus around family and caring for their family and budgeting. Men tended to focus more just on growing their investment and where can that take them, and not necessarily focus so much on the why or the family, or even some of the value-based decisions behind it. And by values-based, I mean, for example, the environmental causes, women-owned businesses, small businesses, things of that nature that tend to be more important for women. And I think in one of our prior webinars, we had touched on that with references. So I apologize if it sounds like I'm just making this up.
Yeah, and I think definitely, I didn't mention it earlier, but when you look at the next generation, something I'm definitely thinking about is, although I don't have kids, is my nieces and even the extended family, and what type of impact I can leave for them. And that's why I'd also say, regardless of your age, which you're starting this journey, even if it's not, you don't anticipate you have a long investment term for yourself, think about the next generation to whom you might want to leave some wealth, and think about how that might be able to impact them.
For sure.
Any other questions? I see a couple people have been promoted to panelists, so feel free to unmute yourself if you have any questions. But let me see if there's anyone else. Here we have another question. Do you know if the climate conference created or identified particular pro-environmental investment strategies?
Oh, that's a good question. I'm actually not sure. And I'm really curious now. I would love to know if I'm sure they weren't promoting certain businesses to invest in, but I can imagine fossil fuels are not so hot right now, or, would be promoted, and also putting pressure on those companies to clean up the way they do, clean up the way they run their industry, perhaps. But specifically coming out of the climate change conference, no, I'm not aware. I'm not sure if anybody else in our group has been keeping more up to date on that.
Any other questions from the audience? Okay. Well, okay, if there are no other questions at this time, Just want to thank Teja for sharing your guidance and your advice and your personal experience. You know, it's a very personal, investing is a very personal journey. And we really appreciate you being candid and sharing some of the tools you've created for yourself and the tools you use outside as well. You know, look forward to having further conversations with you on this topic. I have shared in the chat links to DIA, links to so you can learn more about us, links to becoming a member, and also my email if you'd like to be part of the group that looks at Women of Dharma and any types of events or activities or topics we might discuss. They don't have to be limited to finance. Please do reach out to me. We'd love to have more people involved to make sure we're representing the diverse needs of our audience and our membership. We also want to thank Jose, who has been our tech help for today. We really appreciate it. All the work that you do to make our events go very smoothly. But Teja, I wanted to see if you have any parting thoughts before we end the day.
Sure. I think, and there is a question in the chat, but I can answer that. I can send a quick answer to it on tools for budgeting finances. And I think that's going to be a future webinar as well. So I just want to say to everybody who joined us, thank you, of course. And also that, you know, this is only as intimidating as you let it be, and we all have the capacity to do it. And it's important, not just for ourselves, but for the people in our lives, that we take care of the product of our hard work is what I like to think of it as. And so thank you all and good luck.
Thank you very much. Have a great rest of your weekend.
Thanks. Bye.